Welcome to today's deep dive. I mean, if you look at the desk right now, we have this massive stack of dense study material, basically a comprehensive syllabus on banking law that was originally compiled for exam preparation.
Yeah, it is quite the intimidating pile of documents, to be honest.
Right. But, our mission today is to transform all these legal doctrines, case laws, and regulatory frameworks into an engaging, high-yield masterclass. So whether you're studying for an exam yourself or you just want to understand the invisible safety net holding your life savings, this deep dive is, well, your ultimate shortcut.
Absolutely. I mean, it's fascinating stuff when you really get into it.
So to start off, imagine you step onto a massive suspension bridge, suspended hundreds of feet above a raging river. You don't pause at the entrance to calculate the tensile strength of the steel cables, right?
No, of course not. You'd never get anywhere if you did that.
Exactly. You don't demand to review the engineering blueprints or subject the concrete anchors to stress tests. You just look at the structure. You rely entirely on this invisible framework building codes, and you walk straight across.
And, the modern financial system operates on that exact same psychological mechanism. You are functioning purely on faith in an unseen, highly complex architecture of legal doctrines.
Yeah, handing over your life savings to a commercial bank requires that identical leap of faith. I mean, you never ask to physically inspect the bank's vault before setting up your direct deposit.
Right. You don't bring in an independent auditor to verify their balance sheet.
You just trust the invisible safety net. But today, we're going to peel back the layers of that safety net. We're going to trace the entire life cycle of a banking institution, exploring the tug of war between the banker and you, the customer. And then we'll look at what happens when loans go bad. So let's unpack this. Before we get into the heavy law, how did we even get the word bank?
Well, to truly understand it, you have to look at the foundational concepts. The phrase banking feels so corporate today, but the etymology points to a very physical, remarkably humble origin in early international trade.
Like, how humble are we talking?
The term derives from the old Italian word bancus, or bank, which quite literally translated to a bench.
Wait, like a literal piece of wooden furniture?
Precisely, a wooden bench in a marketplace. If you look back to the early days of the Renaissance, like in bustling mercantile centers like Florence, global trade was exploding.
Okay, so you have merchants arriving from all over Europe and the Middle East, right?
Yeah, exactly. And they're bringing this chaotic array of different physical coins, florins, ducats, shillings. The early financiers would just set up these wooden benches in the open-air public squares.
Just out in the open. That's wild.
Right out of the piazza. They would lay out the currencies on the bench, assess the metallic purity, determine exchange rates, and facilitate trade right there on the woods.
So the foundation of global multi-trillion-dollar finance was just some trusted guy sitting at a table in a crowded square trying to figure out how many Venetian coins equaled a Byzantine coin.
It really was. But, the practice itself predates even the Italian Renaissance by thousands of years.
Really? How far back are we talking?
Well, the Babylonians operated a highly sophisticated, ledger-based financial system as early as 2000 BC.
2000 BC. So wait, what were they even trading?
They were dealing primarily in agricultural commodities. They executed grain loans, silver loans, and they tracked all these debts on actual clay tablets.
That is just incredible to think about.
And then the Romans came along, and recognizing how fragile public trust is, they implemented incredibly minute regulations for private moneylenders. Even in antiquity, they understood that if the public lost confidence in the ledger, the resulting panic would destroy the local economy.
Right, because a bank run in ancient Rome is still a bank run. Okay, so we have this long evolutionary chain from Babylonian clay tablets to Italian wooden benches. But bringing it to the modern statutory framework, if I lend $50 to my neighbor so they can fix their lawnmower and they pay me back with interest, I am functionally acting as a lender.
You are, technically speaking.
But I am obviously not a legally recognized bank. So where does the law draw the definitive line? What is the actual legal threshold here?
So the cornerstone for that definition is located within Section 5B of the Banking Regulation Act of 1949. And the statute is remarkably specific.
What does it say?
It defines the business of banking as the accepting, for the purpose of lending or investment, of deposits of money from the public, repayable on demand or otherwise, and withdrawable by check, draft, order, or otherwise.
Let me isolate the key variables there, because that's a lot. You must accept deposits. The explicit purpose must be for lending or investing those specific funds. The funds must come from the public, and you're legally obligated to return those funds when the depositor demands them.
Exactly. Every single clause acts as a critical legal filter. And the phrase from the public is the ultimate non-negotiable qualifier.
Okay, why is from the public so important?
Let's look at the exemptions under Section 5C of the same Act. The law specifically addresses manufacturing and trading companies. Suppose a massive steel corporation issues a call for public deposits.
Like, they take in millions from everyday citizens promising a fixed return.
Right, they're accepting deposits, yes. But their explicit purpose is to utilize those funds to build a new blast furnace, to finance their own internal trade operations.
Ah, I see. They aren't turning around and lending that money to a third party to buy a house. They are just consuming the capital themselves.
Therefore, legally, they are completely excluded from being deemed a banking business.
Yeah.
A true, legally recognized bank acts purely as a financial intermediary.
Right. It accepts money from the public specifically to channel it, to lend it out to other unrelated members of the public. I often visualize this using a municipal water reservoir analogy.
Oh, that's a good way to look at it.
Oh.
How does that work?
Well, the bank is basically the central plumbing infrastructure connecting two distinct groups of people. On one side, you have individuals with a temporary capital surplus, right? They have excess water flowing in that they don't immediately need.
Okay, the depositors.
Exactly. And on the other side, you have individuals facing a capital deficit. They're in a financial drought, needing a massive influx of water to irrigate a new business venture or buy a home. The bank doesn't drink the water itself. It merely holds it in the reservoir and strategically directs the flow through the pipes.
That reservoir analogy perfectly encapsulates the traditional orthodox model of commercial banking,
Yeah.
just taking in deposits and issuing loans. But the modern financial landscape has aggressively mutated away from that simple model.
Yeah, it really has. I mean, we've entered the era of the universal bank.
We absolutely have.
Because logging into a banking app today is an entirely different experience than it was 20 years ago. The institution holding my basic checking account is simultaneously offering to underwrite my life insurance, broker my mutual funds, manage my pension, and do stock trades.
They're trying to capture every single node of your financial existence.
Exactly. But from a legal standpoint, doesn't that multifunctional nature create a total regulatory nightmare?
Oh, a massive one. An institution can't just unilaterally decide to expand across all these distinct financial domains. In India, for example, if a traditional commercial bank wants to convert into a universal bank, it has to navigate an incredibly dense gauntlet of separate regulatory bodies.
The sheer number of acronyms involved in the syllabus is just staggering. I mean, you have the Reserve Bank of India, the RBI, overseeing the core deposit and lending functions. But the moment the bank offers a stock account, SEBI steps in.
Right, the Securities and Exchange Board of India.
And if they launch an insurance product, IRDA gets involved. Touching agricultural lending brings in NABARD. Housing loans trigger the National Housing Bank, and managing pensions brings in the PFRDA. It's a massive, multi-headed beast.
And if we connect this to the bigger picture, you have to ask why it's structured that way.
Well, yeah, doesn't this hyperconsolidation inherently amplify systemic risk? If my bank is doing absolutely everything from holding my salary to aggressively speculating in global equities to underwriting catastrophic insurance policies, doesn't a failure in their investment division threaten to drain the entire reservoir?
That is the fundamental tension of modern finance, and it's exactly why multiple regulators are involved. A banking collapse isn't just an isolated corporate failure. It has a contagion effect that can trigger a severe macroeconomic depression.
So they have to build walls.
Heavy, impenetrable firewalls between the different divisions. The capital requirements for the insurance wing are calculated and sequestered entirely separately from the core banking department. The regulators are constantly monitoring to ensure that extreme risk-taking in securities can't legally compromise the liquidity pool guaranteeing your checking account.
Which provides the perfect transition to the ultimate boss, the architect of those firewalls. The central authority acting as the load-bearing pillar of the entire national financial bridge, which is the Reserve Bank of India.
Yes, the RBI. It operates as the undisputed anchor of the Indian financial ecosystem.
And looking at the sources, the banking sector is bound by the interplay of two monumental pieces of legislation, right? The Banking Regulation Act of 1949 and the Foundational Reserve Bank of India Act of 1934.
Exactly. The 1934 Act established the central bank's sweeping powers, while the 1949 Act governs the commercial entities.
The chronological gap there is fascinating to me. The RBI Act was codified a full 15 years before the modern rulebook for commercial banks was finalized.
The central authority had to be entrenched before the wider market could be properly disciplined.
So let's analyze the actual statutory superpowers granted to the RBI because their mandate seems to touch like every molecule of the economy. What's their main superpower?
Their foundational superpower is the absolute monopoly on the issuance of physical currency.
But there's a strict internal separation even within the RBI, right?
Yes, the 1934 Act imposes a strict internal segregation. The issue department, which is specifically responsible for printing and managing banknotes, is legally firewalled from the banking department.
The banking department being the side that handles day-to-day operations and interactions with commercial banks?
Correct. The assets held by the issue department to back the currency cannot be utilized to satisfy any liabilities incurred by the banking department.
Basically, you never want the entity managing the daily flow of funds to have unregulated access to the literal printing presses to just paper over a liquidity crisis.
The inflationary consequences of blurring that line would be absolutely catastrophic.
So beyond issuing currency, the RBI also acts as the banker to the government and the banker's bank.
Yes, they manage the sprawling accounts of the central and state governments, and for the commercial banking sector, they act as the central clearinghouse. But crucially, they possess the title of lender of last resort.
That sounds like a superhero title. How does that play out in a crisis?
It's perhaps their most vital systemic function. Imagine a localized panic triggers a bank run. Depositors are demanding cash en masse, and the interbank lending market completely freezes because institutions are terrified to lend to one another.
So the commercial bank simply runs out of physical cash.
Exactly. If they cannot secure funds elsewhere, the RBI is statutorily authorized to step in and inject emergency liquidity.
They act as the ultimate backstop to ensure a solvent bank doesn't collapse just because of a temporary lack of physical currency.
Precisely, neutralizing the panic before it can metastasize.
But they don't just wait around for emergencies, right? They actively throttle the money supply of the entire nation to manage inflation and deflation. How do they actually execute that level of macroeconomic control?
They utilize specialized levers, but the most potent statutory tools are the statutory liquidity ratio, the SLR, and the cash reserve ratio, the CRR.
Let's focus on the CRR, governed under Section 42 of the RBI Act. How does that work mechanically?
The CRR acts as a mandatory, fluctuating safety deposit.
Yeah.
The law dictates that every scheduled commercial bank must maintain a specific percentage of its total demand and time liabilities as a pure cash balance locked away in the RBI's vaults.
Okay, so if a massive influx of retail deposits brings a bank's total liabilities to 10 billion rupees, the bank is legally barred from turning around and injecting that entire 10 billion back into the market as mortgages.
Right, a predefined chunk of that capital must be surrendered to the central bank for safekeeping, and the RBI has the authority to dynamically adjust that percentage up to a maximum ceiling of 15%.
So that's how they engineer macroeconomic cooling. If the economy is running dangerously hot with soaring inflation because too much money is chasing too few goods, the RBI just forcefully increases the CRR.
Exactly. Suddenly, commercial banks are mandated to lock up millions of additional rupees. This instantly evaporates their lendable capital. Fewer loans are issued, consumer spending retracts, and the inflationary pressure is bled out of the economy.
They are essentially turning the massive industrial valve on the reservoir. They constrict the flow when the downstream fields are flooded, and they open it up when there's a drought.
It's absolute macroeconomic control. But the RBI also has terrifying authority over the microscopic internal governance of every individual commercial bank.
Yeah, looking at Sections 10 and 10A of the Banking Regulation Act, the law dictates exactly who is permitted to hold executive power.
Yes. Section 10 outlaws managing agents and permanently bars anyone convicted of an offense involving moral turpitude from banking management.
Moral turpitude. That's one of those deeply evocative legal phrases. It implies conduct that fundamentally offends the community's baseline standards of honesty. If you have a conviction for a systemic fraud or embezzlement, the law views you as inherently incompatible with managing public funds.
Absolutely. And the scrutiny intensifies when we look at the board of directors under Section 10A.
Because historically, bank boards were basically just country clubs for wealthy industrialists, right?
Completely insular. They viewed the bank as a captive financing vehicle for their own corporate empires. They'd approve highly speculative loans to their own subsidiary companies, totally bypassing objective risk assessment.
The ultimate conflict of interest. So how does Section 10A dismantle that?
It mandates that a majority of the board of directors must consist of individuals possessing specialized practical experience in diverse sectors, like accountancy, agriculture, or small-scale industry.
So they force the inclusion of independent experts who can actually evaluate risk, unburdened by the financial interests of the majority shareholders.
And if the RBI determines a board is improperly constituted, they possess the statutory authority to forcefully reconstitute it. They can depose sitting directors and parachute their own selected experts into the boardroom.
They can essentially override the voting power of the shareholders to protect the depositors.
Yeah.
That is intense. And to further neutralize insider abuse, Section 20 implements draconian lending prohibitions, right? Like, a bank is absolutely forbidden from granting any loan secured by its own shares.
Yes, because that creates a highly volatile, reflexive feedback loop.
Yeah, if a bank accepts its own equity as collateral and the market drops, the bank's stock declines. Then the underlying value of the collateral evaporates, making the bank look precarious, triggering a sell-off, which further destroys the collateral. It's a self-feeding death spiral.
Exactly. Section 20 also outlaws unsecured loans to the bank's own directors or their partner firms. It's an impenetrable statutory wall.
Okay, so the entire architecture is heavily biased toward extreme transparency and independent oversight. But here's where it gets really interesting. When I analyze Section 34A of the Act, it seemed to offer a glaring contradiction.
How so?
Well, Section 34A basically says that during specific industrial disputes, a bank cannot be legally compelled by a tribunal to publicly disclose the exact provisions it has secretly set aside for bad and doubtful debts.
That is an accurate reading. It establishes a powerful shield protecting the confidentiality of internal reserves.
But doesn't that level of secrecy give banks too much power to hide bad accounting? Doesn't it undermine the entire ethos of transparency we just talked about?
The optics are concerning, sure, but the underlying legal philosophy hinges on the fragile psychology of the banking public. A bank's survival depends entirely on the unwavering confidence of its depositors.
Okay, so if a routine labor dispute forced a bank to publicly broadcast that it had quietly set aside billions of rupees for anticipated corporate defaults.
The context would be totally lost on the general public. A headline screaming about billions in bad debt provisions could instantly trigger a catastrophic, irrational bank run, even if the bank was simply executing highly prudent risk management.
So the intent is to manage public perception and prevent a panic rather than offering amnesty for financial crimes. And I guess the transparency isn't eliminated, it's just compartmentalized. Because under Section 29, the RBI itself receives these exhaustively audited returns.
Exactly. The bank cannot hide this data from the regulator. And if a tribunal genuinely needs that information to resolve a dispute, they can petition the RBI, who acts as a cryptographic intermediary, verifying the financial capacity without exposing the sensitive data to the public.
That makes a lot of sense. So we've mapped the macro-level architecture. Now let's zoom into the micro-level, the legal relationship between the listener and their bank. Because the law here is surprisingly complex.
It really is. This is where theoretical statutes collide with daily human interaction and begins with the fundamental question, who actually qualifies as a customer?
Which is funny because the massive Banking Regulation Act completely fails to define the term customer.
Right, which forces the courts to rely on historical precedent. The preeminent authority here is Sir John Paget.
What was his framework?
He suggested there must be some recognizable course or habit of dealing in the nature of regular banking business. Historically, courts emphasized the word habit, implying you needed a prolonged duration to establish the relationship.
But modern jurisprudence has fundamentally shifted, right? Away from the timeline and toward the nature of the intent.
Yes, you walk into a branch today, clear the KYC protocols, and open an account with the mutual intent of establishing an ongoing financial relationship. That singular act immediately crystallizes your legal status as a customer.
The duration is irrelevant, but the true complexity is the actual nature of that relationship. Because the most dangerous misconception people have is that a bank acts as a depository or a bailee.
Yes, the safe deposit box mentality. People deposit their salary and visualize the bank placing their specific funds into a digital lockbox with their name on it.
Which is legally totally wrong. The moment those funds cross the counter, a profound legal transformation occurs. The bank isn't your custodian. The bank instantly becomes your debtor, and you, the depositor, are the creditor.
It's a radical shift. In the eyes of the law, every deposit is legally an unsecured loan you are voluntarily extending to the bank. The bank acquires absolute ownership of those specific funds.
They can use that capital for 30-year mortgages or sovereign bonds, whatever. Their only obligation is to return an equivalent value to you upon demand. I think the coat check analogy really clarifies this.
Oh, definitely. Run through that one.
If I go to a hotel gala and hand my expensive overcoat to the attendant, I expect that exact coat back. If they sold it and handed me a different coat of equal value, I'd be furious. That's safe custody. But if I give the bank a 100 rupee note, I don't care if I get the exact same piece of paper back 5 years later, just the value. That's banking.
The distinction between bailment and debt is the engine of the entire system. But banking creates a mutated form of debt. In normal commercial law, the debtor has to seek out the creditor to repay.
Right, if I lend you money, I expect you to come to my office to pay me back when the term expires. But the bank manager doesn't drive to my house to hand me bundles of cash.
Because the debt is only payable upon the explicit, formalized demand of the customer, the bank has no duty to seek you out until you execute a withdrawal or write a check.
And this power dynamic, where the customer is the empowered creditor, can invert violently. The moment you use an overdraft facility, the legal roles flip. The bank becomes the creditor and you are the debtor.
And when the bank becomes the creditor, they gain access to formidable legal weaponry, like the banker's lien.
A lien is basically the right to retain a debtor's property until a debt is paid, right? How expansive is this in banking?
It's legally classified as an implied pledge. It grants the bank sweeping authority to retain securities or tangible assets belonging to the customer that legitimately come into the bank's possession during normal business.
So if a corporate client defaults on a massive loan, but they also routinely deposit high-value corporate bonds for dividend collection, the bank can just unilaterally seize those bonds.
They can, but the jurisprudence heavily circumscribes this to prevent overreach. Most significant exception is safe custody.
Back to the coat check. If I have a safe deposit box with family jewelry and I default on a credit card, the bank can't just break into the box and take my jewelry under a lien.
Exactly. The assets were surrendered for an isolated purpose. Another exception is money deposited for a specific purpose, like explicitly paying a corporate tax liability. The bank can't intercept that for a pre-existing overdraft.
The boundaries of this power were tested in the State Bank of India v. Javed Akhtar Hussain case. That one perfectly illustrates the court checking the bank's authority.
It's a masterclass in the limitations of the lien. The debtor owed a significant amount to the State Bank of India, but was also a co-depositor on a joint fixed deposit with a completely innocent second party.
And the bank, aggressively trying to recover losses, unilaterally froze the entire joint deposit, basically holding the innocent person's money hostage.
The court was severe. They ruled the bank's unilateral lien was high-handed and impermissible. A banker's lien cannot be exercised against a joint account when the debt is only owed by one person.
Which makes total sense. It really reinforces the customer's financial autonomy. And speaking of autonomy, what about terminating the relationship? Can a bank just suddenly decide they don't like my business model and shut my account overnight?
No, the law strictly forbids abrupt termination. A bank is legally bound to provide reasonable notice before shuttering an account.
Which is vital because if a business account is frozen without warning, payroll checks bounce and their reputation is ruined. But how is reasonable quantified?
It's highly fluid, heavily dependent on the case of Prosperity Ltd. v. Lloyd Bank Ltd.
Oh, this snowball scheme case.
Right. Prosperity Ltd. was operating a complex, multi-tiered international snowball scheme. Lloyd Bank knew this, but abruptly decided the risk was too high and gave them a 1-month notice of closure.
I mean, a month seems standard for a normal account.
But the company argued that unwinding a global matrix of cascading payments requires way more logistical runway, and the court sided with the company. A 1-month notice was deemed totally inadequate given the worldwide nature of the business.
The law really adapts to the logistical reality of the client. And it also adapts to the legal capacity of specific types of clients, what the syllabus calls special customers.
Yes, like dealing with a minor. A minor suffers from an inherent legal incapacity to enter binding financial obligations.
So a bank can open a savings account for them, but if they authorize an overdraft and the minor uses it to buy a car, the bank is legally stranded. They can't sue a minor for a void debt.
They just have to absorb the loss. The scrutiny also escalates for joint stock companies. A bank manager can't just take a director's word for it. They must rigorously verify the company's memorandum and articles of association.
They have to invoke constructive notice. Does this company actually have the legal authority to borrow this money? If they fail to check, and the loan is ultra vires beyond the company's powers, the loan is void.
Yes. And there's also regulations surrounding per-nation women, which shows how banking law intertwines with sociocultural realities.
Right. In certain cultural contexts, a Purdonatian woman observes strict seclusion, remaining behind the veil, isolated from the commercial sphere.
The judiciary recognizes that this isolation cultivates a profound vulnerability to undue influence, often from male relatives. So when a bank engages in a transaction with a Purdonatian woman, the burden of proof shifts aggressively onto the bank.
They have to prove that the contract was fully explained in her native language, often mandating independent legal counsel or a magistrate's verification to ensure absolute informed consent.
They must build a fortress of informed consent around the vulnerable party.
Which is the perfect bridge to the broader framework of consumer protection, because the power dynamic between a massive bank and an everyday retail consumer is wildly skewed. The bank writes the contracts, sets the fees. What legal shields do we actually have?
The RBI formulated a comprehensive charter of customer rights built on 5 foundational pillars.
Hmm.
The first is the right to fair treatment, mandating absolute anti-discrimination.
No denying services based on gender, religion, caste, etc.
Exactly. The second is the right to transparency, fair and honest dealing. This targets the weaponization of microscopic fine print. All fees and penalties must be explicitly disclosed in clear language.
The third right is crucial, the right to suitability. This was designed to combat the industry-wide plague of mis-selling.
Right, because bank incentives often prioritize commission over fiduciary duty.
Like when a risk-averse retiree wants a safe fixed deposit, but the bank executive pushes a highly complex, volatile unit-linked insurance plan, a ULP, just to hit their quarterly commission targets.
The right to suitability legally bars that. The bank must assess the customer's actual financial standing and risk tolerance. Pushing an illiquid, high-risk product onto a vulnerable retiree is a punishable violation.
The fourth pillar is the right to privacy, which is huge today, since banks know literally everything about you based on your transaction metadata.
The banker's duty of secrecy is fiercely protected, tracing back to the Tournier v. National Provincial Bank case. They can't just sell your data to marketers.
But there are exceptions, right?
4 specific exceptions. First, compulsion under law. If a judge issues a subpoena, the bank must surrender the data. Second, public interest. If the account is funding terrorism or massive fraud, the bank must alert the authorities.
Third is the interest of the bank. Like, if you default on a mortgage, they obviously have to disclose your financial history in court to sue you. And fourth is just the customer's consent.
Yes, but rights are meaningless without enforcement. So the fifth right is grievance redressal, operationalized through the banking ombudsman scheme.
So if an ATM eats my 50,000 rupees and the branch manager just, ignores me, I don't have to hire a lawyer and go to civil court. I can escalate it to the banking ombudsman, which is free and fast.
Exactly, and completely independent from the commercial bank,
Mhm.
Plus, there's an internal ombudsman mechanism created in Tom 15.
Basically an embedded auditor inside the bank whose sole job is to automatically review any complaint the bank is intending to reject.
Exactly, subjecting their own denials to an independent stress test.
Now, we've talked about our shields, but the bank has its own rights. And there's one doctrine in the syllabus, the right of appropriation, that sounds like a terrifying loophole. So what does this all mean for you? If you deposit your salary and you have a 5-year-old forgotten debt, can the bank just use its right of appropriation to swallow your paycheck?
What's fascinating here is the legal nuance, specifically Clayton's rule. If you owe the bank multiple debts, say a personal loan, a vehicle loan, and an old overdraft, and you deposit cash.
If I explicitly tell the teller to put it towards the vehicle loan, they have to do that. The rule of specific instruction applies.
Correct. But if you remain silent, say you just do a digital transfer with no instructions, the power transfers to the creditor. The bank can apply that unallocated capital to A and D of the outstanding debts.
Even a time-barred debt, because, that blew my mind in the syllabus.
Yes, a time-barred debt basically means the statute of limitations has expired, say 3 years have passed. The bank cannot legally sue you for it anymore. The legal remedy is dead.
But if I accidentally deposit unallocated funds, they can snatch that fresh capital and apply it to this legally dead debt.
They absolutely can. Because while the statute of limitations destroys the right to litigate, it doesn't extinguish the factual existence of the debt. You still ethically owe it. They just have to inform you after they appropriate it.
That is staggering. It highlights why you have to clearly document the purpose of every single deposit. If you leave it ambiguous, the bank wins.
Okay, so we know how banks handle liquid cash. But what about the mechanics of paper checks? When I hand over a check, who is legally responsible if something goes wrong?
The ecosystem is split into two roles: the collecting banker and the paying banker.
The collecting banker takes the check from the customer and gets the funds. The paying banker actually holds the funds and pays out.
Exactly. Sometimes it's the same bank, but the duties are distinct. Let's introduce a catastrophic scenario. A thief steals a massive dividend check meant for me, brilliantly forges my signature, and deposits it at their bank. Their bank, the collecting banker, processes it and gives the thief my money. Is the collecting banker liable for facilitating the theft?
It hinges entirely on Section 131 of the Negotiable Instruments Act. This protects the collecting banker, provided they acted in good faith and without negligence.
But without negligence is an incredibly high bar.
It is. The court will audit their procedures. And crucially, it looks at the KYC process when the thief originally opened the account.
Oh, right. So if the bank lets some unverified stranger open an account with fake ID and immediately deposit a massive third-party check, they lose their Section 131 protection. They were negligent in onboarding, so they have to refund the stolen money out of their own pocket.
Exactly. But if they executed flawless diligence and the forgery was simply perfect, the bank is protected and the true owner suffers the loss.
Wow. And if I end up in a dispute over account balances, are the entries in my passbook considered absolute truth?
Emphatically not. Passbook entries are only prima facie evidence, meaning at first sight. They are presumed accurate until proven otherwise. If a clerk accidentally adds an extra zero to your deposit, you don't magically get to keep it once the bank proves the clerical error.
That brings up the Bankers Books Evidence Act of 1891.
Okay.
I was reading about this, and the historical context is hilarious. Before this act, if a court needed to verify a bank ledger, what did they have to do?
Total operational paralysis. Banks had to physically transport their massive hundreds of pounds ledgers to the courthouse on horse-drawn carriages.
So the actual branch is totally crippled because their core database is literally sitting on a judge's desk across town.
Yes. So the 1891 Act created a legal fiction. A bank manager could generate a certified copy of specific entries, and the court had to accept it with the same evidentiary weight as the physical book.
I love that. It's basically, the 19th century equivalent of sending a notarized screenshot instead of having to hand over your actual unlocked smartphone to a judge.
And Section 5 of that act also dictates that bank officers can't be compelled to produce original books in cases where the bank isn't even a party, preventing third-party harassment.
All right, we've traced the money going in and moving around. Finally, we have to look at what happens when money goes out as a loan and the customer fails to pay it back. The end of the line.
Before recovery, the bank must rely on good lending principles: safety, liquidity, profitability, purpose, and security.
But there's a massive tension there, right, between liquidity and profitability.
It's the central paradox of banking. Liquidity means investing in short-term, low-yield, safe assets. Profitability means locking capital into long-term, high-yield, risky ventures. The art of banking is managing that exact ratio.
Because if you lock everything up for 20 years, a sudden bank run will instantly destroy you. But even with flawless underwriting, defaults happen. And recovery isn't a free-for-all, is it?
No. The RBI and Indian Banking Association heavily regulate recovery to prioritize borrower dignity. Recovery agents can only contact defaulters strictly between 0800 and 2000 hours.
This reminds me of the mythological rules for vampires. They can only come to your house if invited, they have strict operating hours, and there's a code of conduct. If they break the rules, the law steps in.
That's a great analogy. They must respect agreed-upon places of contact. They can't just show up at your workplace to humiliate you. And the agents themselves must be formally trained and authorized by the Indian Institute of Banking and Finance.
No physical intimidation or harassing family members.
This raises an important question, though. While borrowers have a legal obligation to repay, lenders are legally bound to humane treatment. But what if the borrower uses their massive legal budget to infinitely delay in civil court?
Right, because civil courts take forever.
Which almost paralyzed the banking sector.
Yeah.
So the legislature created debt recovery tribunals, or DRTs.
Specialized tribunals just for bank loans above 20 lakhs, streamlining the process outside of sluggish civil courts. They cut through the delays while still maintaining due process.
Exactly. DRTs balance the bank's need for swift recovery with the customer's right to a fair hearing.
But there is one wild exception to debt recovery buried in the international law notes: the diplomatic exception.
This is where domestic statutes yield to public international law. Sovereign representatives of a foreign nation have absolute immunity.
So if a foreign embassy in New Delhi severely defaults on a massive overdraft facility provided by an Indian bank,
The bank holds a valid debt, but they are legally paralyzed from enforcing it against those specific diplomatic assets. No domestic DRT can freeze or seize that account.
the bank's legal machinery just stops at the embassy gates. They'd have to seek resolution through complex state-to-state diplomatic channels. That is a fascinating collision of legal realms.
It truly is.
And that collision brings our massive journal to its conclusion. We've decoded the ancient origins of banking on wooden benches, the iron grip of the RBI, the surprisingly delicate dance of the debtor-creditor relationship, our consumer rights, the mechanics of evidence, and the strict boundaries of loan recovery.
We covered a tremendous amount of ground.
Yeah, you are now armed with the legal knowledge of a banking scholar, ready for that exam, or just ready to actually read the fine print on your next loan agreement.
Definitely read the fine print.
But I want to leave you with a final provocative thought. We've seen how heavily regulated banks are today to protect your money. We rely on the RBI, human fiduciaries, and physical branch hours. But as we move toward purely digital currencies, decentralized finance, and AI-driven lending, who will act as your lender of last resort? In a future without physical branches or human managers, how will the laws of the banker-customer relationship evolve? Something to think about the next time you tap your phone to pay.